Hello and welcome back to Kitco Mining's Digging Deep with me, Paul Harris, in which we take a closer look at some of the most interesting news items in the mining and exploration space. Joining me today is John Feneck, principal and founder of Feneck Consulting. John, welcome back to Kitco.
Thanks for having me back, Paul.
We have a lot to get through this week and many and very different news items. The World Gold Council published its first quarter 2025 report this week. Inflows into global gold ETFs rocketed, where demand was 226 tons. This was the strongest demand in the first quarter for 3 years. Central bank buying continued. They bought 244 tons of gold, and investment in gold bars and coins remained elevated at 325 tons. On the supply side, gold supply was 1% higher as mine production inched up to a record 856 tons in the quarter. John, what did you make of this report?
So we've been saying, like so many of our peers, that the central bank buying theme has been going on for years, right? And I think personally that it got more exaggerated when Russia took things on in February of 2022. You could see an immediate spike in Chinese buying and in other countries buying more at the central bank level. And that has not, backed off as things have become more uncertain in the world, right? And now we're entering a very uncertain period in 2025, I think, globally. So countries are getting on board with that narrative that we need to protect what we've earned, and we do that by buying something like gold or silver, right? Now, I will say, if you're saying on the retail side, gold is doing quite well. I know in the U.S., silver is struggling, right? And that's still very frustrating for investors, including myself. When you look at where we're recording this, gold's around 32.30-ish, and silver's under $32, which implies that the gold to silver ratio is 100 plus as we record this, which is hard to even say, but it's true. And investors are kind of fed up with silver at this point because it's not acting as it should in this environment. Clearly, we should be testing 35 and breaking that at some point over the next 6 months, in my opinion. But getting there is a harder road than people expected.
Well, timing is everything in investment. And so is there a case that, silver's not there yet, and the yet being the important word?
Yeah, I mean, you can see it in the chart, Paul. Last year, we tried to break through that 32 to 33 range. We failed a couple times, and then finally we did it this year, but then failed at that big round number of 35 pretty miserably. And so now at 31 and change, we've got to hold 30. I think that's critical because that was major resistance for 11 years. And then take another shot at 35 sometime in 2025, which I think is going to happen. So that implies a nice gain from here, right? If you're at 31 and a half-ish or 32 even, you're looking at a nice move to 35. But really, silver equities are the beneficiary there, right? Because once we break 35 to the upside, I think we test 37 very, very quickly. And then there's not a lot of resistance all the way to the all-time high of 50.
Okay. Now, one of the things that sort of struck me about the gold, all the gold news out this week, the gold price continues to set record levels, even though it's pulled back a little bit from 3,300 to 3,200 US dollars per ounce. Despite that, there's been a lot of retail buying bars and coins and jewelry, particularly in China and Saudi Arabia. So, retail investors in the East, Middle East and Far East, they're still buying heavily into gold despite the price being so high. What can we read into that, John?
That's a great point you make, Paul, because you and I both know that doesn't happen historically, right? The Chinese, the Indians, they don't buy at all-time highs. They wait sometimes, and they're not waiting now, which is telling you something, that this environment is very much like a FOMO type investment environment for gold, everything, in my opinion, except for gold stocks. That's a whole other ballgame. And you really have to still use a rifle approach in gold stocks, not a shotgun approach. It's just we're not there yet, unfortunately, despite having great earnings from companies like Agnico and Newmont, the two largest holdings in GDX just last week.
Now, it does seem quite interesting that despite gold being at high prices, the retail buying would suggest that people sense or feel gold is going to go higher, so they're buying now so they don't have to pay more later on.
Yeah, My YouTube partner, Don Durrett, and I talk about this every week on our show on the Feneck Commodities Report. We talk about the fact that gold's floor keeps rising. We were talking 2,500 in Q4. Then we said, well, 26 to 2,700, and now it still looks like the new floor in Q1. And now we're talking, 27 to 2,800 looks sort of like that new floor. And so the chart on gold just looks amazing. And you have to buy something gold related in this market. And for me, that's equities.
Now, John, it's interesting you said that you and Don continue to raise your gold price floor. What's happening in the finance world? Are the banks doing the same?
Great point. Yeah, absolutely they are. And I spent most of my career working for larger institutions like Bank of America Merrill. And to see BOA Merrill come out with a $3,500 gold target just a few weeks ago was amazing to me. I mean, go back and look at their work in 2016 during that rally. They were one of those banks at 1,100 gold. That was their thesis, right? Now they're at 3,500 gold 9 years later. That is amazing. And so as clients, we have to look at this and say, okay, the contrarian in me says that that's a bad thing, that all these banks are getting on side with gold, right? But it's really not a bad thing from a funds flow perspective, because when you look at fund flows, that's really important to equities going up, et cetera, right? And UBS has raised their target to above 3,200 gold now. Goldman Sachs just came out at 3,700 gold. I'm not going to quote this because I'm not 100%, but I think JP Morgan is even higher than that right now. I don't know the exact number, but I think it's closer to 4,000 gold, which you and I both know JP Morgan's been busted for manipulating gold and silver and paid, millions and millions of dollars in fines, and they're the highest price target. So this is the environment we're in. It's absolutely amazing for investors, but you still have to use more of a rightful approach and work with professionals like myself that know how to look at charts and try to guide you through the process.
I've read that $4,000 figure somewhere, but I can't recall which bank that was associated with. John, let's take a little bit of a step back. Why has gold rallied so much? We have a US Federal Reserve meeting next week. There's been a lot in the press about the friction between US President Donald Trump and Federal Reserve Chair Jerome Powell. Are these factors driving the gold price as well?
Yeah, if you don't mind, I'll comment a little bit on the Fed and the broad market activity, because I think it's important for investors. I'm a firm believer that many investors that are listening to this have some fun money in our sector, but their real money is still in their 401k. And that's really, really susceptible in this kind of a market. Let's talk about the Fed first and the broad market second. So the Fed is May 7th. There's a 7% probability right now that they're going to do anything next week in terms of a cut. That's not going to happen. Then we have to look at June 18th, and that's an eon from now in markets like this. And that's my concern, is that May 7th, Powell and just is very stoic and just says, hey, this is the deal and we're going to be data dependent. And then Trump, May 8th, comes after him once again. If we look at why the broad market has rallied here since April 21st, it's because Trump backed off Powell. Now that is on the table again, I think, as early as May 7th and 8th. I don't understand why the broad market is rallying like this. But to talk about that action, we will buy certain sectors. Like right now, we've bought a little bit in healthcare to just hedge our bets. That's not part of our mining portfolio. We bought a little Pfizer recently, PFE, the largest, pharma play out there. Obviously, if people didn't know about Pfizer in 2020, they found out during COVID. And also some microcaps like Immunoprecise, IPA, like the beer. This is a 45-cent stock that trades on the NASDAQ. And if you look at a 5 or 10 year chart of either of those companies, I mean, exponential potential for a value investor, right? And so we're looking at hedging our bets a little bit in mining right now and looking at companies that are in, COVID, obesity, diabetes, like the two names I just gave you.
Okay, let's bring things back to the mining sector. There was more first quarter results this week. Ivanhoe Mines, their earnings leapt 50% to $122 million US. For others, such as Alamos Gold, high gold prices make for higher costs. Alamos reported a 35% jump in their all-in sustaining costs to $1,805 per ounce, which included an additional $230 per ounce from share-based compensation costs because of the 45% increase in the share price during the quarter. On 125,000 ounces of production in the quarter, that's about $29 million of additional costs. John, is this as crazy as it sounds?
Yeah, I mean, we're going to start seeing some crazy things. If you and I thought we saw crazy things in 2011 and 2012 with companies making more money, this time around, it's going to be much worse. So I think I try to invest with companies that are going to be on side with investors, and there's a number of ways they can show that. But, there's a lot of juniors out there, Paul, that I think you and I are very honest with investors about the junior market, but we also should give some of these CEOs credit for not taking salaries in a market like 2022 through 2024. I mean, there's a lot of people I can name in that regard, and they're hunkering down, waiting for an environment like this, right? Like one that comes to mind is Triumph Mining, TIGCF. I mean, John Anderson literally mothballed his project for 3 years and is now bringing it, out at 3,000 gold. Great idea, right? Like I wish more people were better stewards of capital in our business. Also, to comment on what you just said, look at another major, Agnico Eagle, right? AEM. I just mentioned them a minute ago. Their earnings report last week is under 1,200 AISC. AISC stands for all-in sustaining cost per ounce. That is phenomenal, and that's one of the reasons we own AEM. Is like they're just making hand over fist money in this kind of a market, and their costs aren't accelerating that much.
I don't fully know what I think about this. John McCluskey at Alamos has done a great job. Their share price is up 100% year on year, so he's done a great job there. And yes, companies, CEOs, executive teams deserve being rewarded for that. But given the focus on keeping a lid on all-in sustaining costs and costs, this sound, it's a bit of an anomaly, and that's why I sort of mentioned it here. I need to think more about this. But as you say, with a lot of companies in that position up over 100% over a relatively short period of time, I expect we're going to see more of these kind of jumps to all-in sustaining costs due to executive compensation.
Yeah, it's very possible, but I would say that we're okay right now because margins are still very wide, right? When you're at even 3,000 gold, forget about 3,200. If your all-in sustaining cost is 1,800, you're making $1,200 an ounce. That's just unbelievable cash flow. So when you go back and look at 2011 and 2012, Paul, look at the major names like Alamos, Agnico, Newmont, anything. We weren't seeing margins like that at all. I mean, it just was much more thin margins, yet these stocks ran really hard. We're just in a different environment. Remember, 2011-12 was coming out of 08-09, kind of, right? So people flocked to our sector after a crisis. We may be approaching another crisis right now because these prices in the NASDAQ and S&P are just not sustainable.
Okay, well, let's talk about some M&A action. Zijin Mining is to spin off its overseas gold mining business into a new unit and seek a primary listing on the Hong Kong Stock Exchange. US investment bank Jefferies noted earlier this month that while major pure play gold mining companies are trading on average at 16 to 17 times the 2025 estimated price to earnings ratio, Zijin trades at just 11.5 times. Its non-China gold portfolio includes the Buriticá mine in Colombia, Norton in Australia, Rosabelle in Suriname, and it has other mines in Central Asia as well. Zijin aims to reach 100 to 110 tons per year of gold production in 2028. It's guided about 86 tons for this year. John, Zijin has been a leading light in gold M&A in recent years. Will a Hong Kong listing see it push for more, do you think?
Yeah, possibly. I mean, when you're kind of in that mode as a company, you're going to continue to do what made you successful, right? I think there's going to be a lot more M&A activity in our sector in 2025 and 2026. I mean, there's just too many companies out there. They need to start joining forces and figuring out marketing plans. And, it drives me nuts, Paul, as you know, we both run conferences, and it drives me nuts when I hear companies at 3,200 gold. Like, I'll think about attending your conference. It's like, this is a time you have to market your story and get it in front of investors. I get it that the last couple of years have been difficult, but some of these companies still just don't do a good job on their websites, their presentation deck, attending the right conferences. It's very frustrating as an investor.
Now, two companies that may be going out shopping soon are Torex Gold Mines and Artemis Resources. They are single asset producers. They both declared commercial production and development assets this morning. Artemis with its Blackwater mine in British Columbia, and Torex with its Media Luna expansion at its El Limon Guajales project in Guerrero in Mexico. They're both going to be big producers, producing several hundred ounces a year, very low cost, so they can be throwing off cash and looking to get out of that single asset producer trap. So they're possibly going to be big candidates to go out shopping and buying other companies at some point in the near future. Sticking with M&A, Australia's Alcan Resources and Canada's Mandalay Resources agreed a merger of equals valued at 898 million Canadian, with three cash-gen operating mines with forecast gold equivalent production of about 160,000 ounces for this year. That's from the Tomingley and Costerfield mines in Australia and the Björkdal mine in Sweden. The merged entity will continue as Alcan Resources with management based in Australia. The conference call was held at 7:30 a.m. Sunday time, Monday morning. And if I was a Mandalay shareholder in Canada, I'd be annoyed as this was Sunday night. It does seem a little inconsiderate for Mandalay's Canadian investors and certainly perhaps not treating them as equals. My gripe aside, John, it's good to see smaller companies consolidating. You mentioned earlier that there's too many companies in the sector. So does the sector need more of this kind of consolidation?
It does. And we like what Mandalay is doing. They've got a tremendous balance sheet. That ticker is MNDJF. They had, the last time I had lunch with them, which was 2 months ago, they had 80 million in cash and zero debt. I mean, that's the kind of stuff you look for, whether you're a mining investor or just an investor in general, right? Like, I mean, one of the best balance sheets out there for a smaller producer. But interestingly, they're the largest producer of antimony in North America, which a lot of people don't understand. Antimony is a critical mineral that is hardly followed by the street. We talked about Perpetua on your show, PPTA, 2 years ago, right? And then Morgan Stanley wrote it up, like, I think about 2 years ago to the day. And that got me really interested, because when you see Morgan Stanley talking up critical minerals, like, this is a major, major theme that most investors are missing.
Absolutely. John, with this particular transaction, it's interesting that the Australian listing will be the focus going forward. To what extent or not is the ASX a more attractive domicile or more attractive market for the junior gold producers at the moment?
Yeah, well, think about it. Australia, gold and Aussie pricing, right, has been at multi-year highs. Like, this isn't new for them, right? So the market in Australia is difficult as a U.S. investor because a lot of those ASX companies don't have U.S. equivalent listings. So you have to find an advisor that can buy ASX listed companies. But I hear this a lot from CEOs that, hey, we're going to try to get an ASX listing because the buyers that track that exchange are just more rabid buyers of gold stocks.
So it sounds like a very good outcome there for both companies. Now, let's continue talking about critical minerals. Big news this week, the US and the Ukraine signed a natural resources deal that will see the US Treasury establish a jointly owned reconstruction fund to invest in infrastructure and resource projects in Ukraine. The fund will invest in mineral, oil and gas projects as well as related infrastructure and processing. The fund will be jointly managed with investments agreed by both parties. The deal will not include, however, compensation for previous military support the US has given to Ukraine as it battles the Russian invasion. However, all new US military support will be treated as investment into the fund. The deal will grant the US most favored nation access to any new natural resource project in Ukraine. But a key win for Ukraine is that the deal acknowledges Kiev's plans to proceed towards EU membership. John, this sounds to be a good deal for the Ukraine. It sort of guarantees US support for the country. Is this a good deal for the US?
The U.S. has to be concerned about everything critical minerals, if I'm right, because we're already in a commodities war with countries like Russia, China, et cetera, in my opinion. So any way we can get access to things as a U.S. leader, investor, average citizen, we need to be thinking about these things, right? And you see Trump agrees with me. In March, he basically put out an EO, an executive order, talking about, hey, put all the U.S. critical minerals stuff on my desk in the next 10 days. Like, I've never seen a president do this. I think Biden did something like 3 years ago or something that was so small, no one even saw it on page 40 of the newspaper. But Trump is like beating the table on this. And as an investor, if you're not paying attention, like, you're going to miss something here. Because in April 15th, he doubled down and he said, hey, I'm not kidding. Like, I really want this information. And as you know, Paul, I spend a lot of my time on the phone with CEOs. I mean, the CEOs I'm talking to right now in critical minerals are the most excited I've ever heard them, going back to the inception of my portfolio almost 10 years ago.
Now, things are moving very fast in the critical mineral space. You mentioned a couple of things there, John. Another thing coming out of the government, the US government recently, was the potential for permitting in weeks rather than months or years. What else of note do you think has happened recently out of Washington?
So what's happened since March with Trump, Trump's CEO, is that I'm hearing the DOD is literally making outbound calls, or at least following up on calls from companies to address that, we are, as a country, far behind, let's just say, China, right? China's kicking our butt in producing critical minerals, and at least the U.S. now gets it, and they're starting to do something about it. It's far too late, in my opinion, but maybe not. You never know. I mean, permitting is the major problem, and funding, of course, that we see for juniors. And if you can get permitted faster and you can get funded through grant money, I mean, what a tremendous opportunity for shareholders. There's so many companies, Paul, that are coming to my conference. American Tungsten is one. They've already put forth, publicly information to the DOD and the White House. That one's DEMRF. Guardian Metal has talked publicly about this many times, GMTLF. And then you've got Stillwater, which is one of our larger holdings in full disclosure, which, I've been asking them, being a Montana project, like, hey, what's the deal in Montana? Because I don't know every U.S. state, right? It's too much information to track. But interestingly, Mike Rowley, the CEO there, has talked to locals, in the government in Montana, and getting a lot of support for his large project that's, attached to Siboney's in Montana. So there's a lot of exciting things happening, and I wish more investors would take a look at this now, because some of the pricing can get really crazy. We just saw a $15 million U.S. tungsten deal yesterday that surprised me, meaning grant money, right? Like, this is like non-dilutive to shareholders. So if they're going to be, and we pointed out on your show before, Fireweed got a $35 million check in December, right? So if we're seeing like companies like this get between 10, 15, and on the high end, maybe 35 or $50 million free checks, like, it changes the dynamic for a junior.
Absolutely. This is going to be something I think we're going to be talking about successively throughout the year as we do these. Back to gold. G Mining Ventures published a feasibility study for its Oko West project in Guyana to produce 350,000 ounces a year for 12.3 years at an all-in sustaining cost of $1,123 per ounce. The project will yield an estimated after-tax IRR of 20% with a 2.9-year payback at a $2,900 per ounce gold price, following an initial capital cost of $972 million. A successful development would bring G Mining to an annual production of about 500,000 ounces a year when added to its Tocantinzinho mine in Pará in Brazil that it brought on stream last year. G Mining Ventures has grown rapidly over the past year. It now has a market capitalization of about 4.3 billion Canadian dollars. John, G Mining Ventures has been a great success story, and perhaps one of the reasons it stands out is because there are so few development success stories in the gold space. They've done what they said they were going to do. They've done it well, on time and on budget. They're reaping the rewards. Why does this stand out as such a rarity?
Well, the mining business, Paul, as you know, is so challenging. There's so many things that can go wrong. Look at Victoria Gold just a few months ago. There's so many names I could name that haven't worked out, right? And that's why you have to buy a basket of stocks. You can't buy 5 or 10 names unless you're really, really wealthy. And have the ability to maybe miss on 60% of your ideas, right? Like we own 60 stocks, 60, not six. So we're spreading our risk among many, many different names so that we don't get hurt in a scenario like that. Congratulations to G Mining. I just talked to a development company last week, NextGold, NXGCF. I interviewed them with Don Durrett on the Feneck Commodities report. And I was really impressed by Kevin Bullock and what he was saying about, hey, we at Signal Gold, where I used to work, we merged with the former Treasury Metals to basically combine NextGold with almost 7 million ounces of gold. Like they're the largest development play, I think, right now in Canada that I'm aware of. And the cool thing is they have the team to build either of those projects, right? You and I both know there's a lot of juniors that can't build anything, although they kind of purport that they can. This team actually can build either project, and they expect to make a decision on which they're going to focus on later this year.
The danger of answering my own question to you, John, I think a number of companies who don't have the ability to build mines often try, and that's perhaps part of the reason for so few success stories. Interesting news out of Barrick Gold this week. It's going to change its name to Barrick Mining. And as part of that process, it plans to change its New York Stock Exchange ticker from GOLD, gold, to B. Although some wags on Twitter came up with other four-letter tickers that they feel better express what Barrick has become. John, B is for beta. Is Barrick acknowledging it is no longer the gold space alpha?
That's hard to say, and I don't want to get on Mark Bristow's bad list. But I would say that look at this. Look at the share price. Look at the chart. The chart tells you what's happening with some of these majors, right? Draw a chart of GOLD on AEM and tell me what you think, right? Not every gold company is created equal, and that ticker GOLD is something that I think they'll miss down the road because it's going to be something someone should grab quickly.
Well, that's my next question for you. With Barrick voluntarily giving up GOLD, which gold company wouldn't want GOLD as its NYSE ticker? So the big question, who is going to move in and pick up what will be the now vacant GOLD ticker?
I think you and I should talk off camera about starting a gold company because we should grab that immediately.
And then work out what we're going to do. Yeah, absolutely. Okay, before I let you go, John, you have a busy May ahead of you with a couple of conferences. Tell us about those and what you are personally looking forward to from them.
Sure, Paul. I got into this conference business somewhat reluctantly about 2 years ago, and it's become more of a passion for me as I see so many conferences not delivering for companies, right? I really care about my clients, but I also care about my companies that I work for on the consulting side or I just own, right? I feel like a lot of them spend money at the conference level and they're not getting what they deserve in terms of exposure. So we're trying to keep both conferences in Florida at the Four Seasons, May 11th, and in Atlanta, Georgia, May 14th at the Whitley Hotel. Boutique in nature, right? So we have 30 or so companies attending, not 100. And we have, 100 or so clients showing up, not 1,000, right? And the clients are going to be accredited, which means that they're going to be screened to actually be wealthy, and two, they're actually buying stock, right? Like we don't want people that are thinking about it. If you can't make a decision at $3,200 gold, in my opinion, you're never going to make a decision. So, and then secondly, companies need to think more intelligently about the conferences they're attending or the social media packages they're buying. I mean, there's so much fluff out there in our sector, Paul, where these companies pay exorbitant amounts of money to get exposure to things that aren't doing anything for their share price. So investors are getting a little bit tired. And I think companies the smarter ones are becoming aware of that at 3,000 plus gold.
Excellent. Well, I'll be there at both of those conferences. I'm looking forward to seeing you again in person, John. John Feneck, thank you very much for joining us today.
Thanks, Paul. Look forward to seeing you.
And of course, to our viewers, if you like what you see, don't forget to hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.